Hello, you guys. Thank you for being here. I'm trying to turn on Instagram here, and we're going to go live in just a little bit on both. Okay. I was watching a video today to try to see if I can figure out how to use that. There's a couple streaming platforms that you do all at the same time. Eventually, I'll get to it, but the purpose of this is to be able to record this video and then put it back later on the website. So it's for viewership for later. But since I don't want to be, I'm too lazy to be recording these videos to edit them and to put it away. I just want to do it live. So then it's already on people's hands. We have been doing Zoom for a very long time, and we've been keeping it as a closed group. But as the group grows, we want to make sure that it's available to everybody that's been asking questions, and the videos have been shared later with the other clients that are not available on Tuesday nights. So that's why we're starting to do the streams live both on YouTube and on Instagram. I also do on Rumble, so because that goes straight to Rumble. So if you have an account on Rumble, you can watch live as we're doing this. So thank you again for being here. Last week was the Halloween, so everybody was getting out candy. So we didn't meet last week, but today we're going to be talking about 401k. The reason why I chose the topic for 401k is that yesterday, November the 6th, 1978 was the first year that the 401k law became rule. And so the 401k program is 45 years old this year. And so if you have a 401k plan with your employer, that whole law became effective in 1978. So yesterday, November the 6th, it was 45 years old. So that's why I decided to talk about that. There are a lot of younger couples and even young adults that ask me questions when we talk about the benefits of preparing for the future and retirement. And we go through, especially the Social Security benefits that people are still paying into. And when we start looking at what's going to be available to them as you register your Social Security, you create your platform and you see how much money you're going to have available for you if you continue to contribute the max every single year on your working years, what you're going to be able to withdraw for your regular Social Security benefits. Most people say that's not going to help me pay my bills. I'm not going to be able to live in retirement with my Social Security. Then of course retirement becomes a conversation, and the most common way that people understand to prepare for retirement is a 401 plan or a retirement plan that is funded or prepared for you by your employer, because most people work for other people. And so that's the most common idea. And so I just wanted to go like dial down really low to explain it to a fifth grader what a 401k plan is, and then show a little bit of the pluses and a little bit of the cons attached to those types of plans, and then see if you have any questions. I want to make sure that you know how to contact me. So if you go to annafarrell.com and click on contact me there. I always get messages. You can always comment on the videos that you're watching, and then I'll be able to talk to you later. If you don't want to comment publicly here, you can always send me a private message and I can answer any of your questions. The reason why I do these one-on-one conversations is because the vast majority of the times, the financial situation that you are in is not necessarily what everybody else is going through. So that's why it's important to have that one-on-one conversation when you have these questions regarding these things that we talk about on our Money Talk every Tuesday night. So let's talk about a 401k plan. So the name of 401k, it's actually the name of the law that came into place. And so it's written on the IRS code. And if you go to item 4401 and the letter K, which the 401 is divided into A, B, C, D all the way, and you get to the K, that's where it talks about the employer sponsored plans. So this is so a 401k is another name for a retirement plan that your employer sponsors on your behalf. So when you work for somebody and you are an employee, you're the worker, the employer, your boss. prepares a plan where every time you receive a paycheck, a portion of that is taken away before it comes to you. So your paycheck has already the 401k, 401k amount withdrawn from that, because they're gonna, before they give you your money, they're gonna take some of that money and they're gonna invest it on your behalf onto this retirement plan for all these years that you work. So when you retire, you have a salary, you have money to withdraw from this plan that has been saved all these years that you've worked. So most of the places that you go to work for will have some type of a retirement plan. Why do they offer these types of retirement sponsor plans for their employees? Number one is because for the employer, for the boss, it's a tax benefit for them to do that. So they receive a benefit from the government with their taxes. So your boss, your employer, the owner of the company that you work for, they also have to pay taxes on the income that they have from their business. Well, the government provides them a benefit if they offer these types of programs for you to enroll. Now, how many of you remember what you signed when you went through onboarding on any of your jobs? When you go to onboarding, you're there for orientation, to sign all the paperwork, choose your health benefits, whatever. You have to sign all those papers. And in the bundle of papers that you sign through your onboarding is the information for your retirement. Most of the time, it's one or two boxes that you check, one or two papers that you sign, authorizing them to withdraw the money from your check and put into these types of sponsored plans. The money's going to be there, it's going to grow over time, and then either you stay with the company forever until you retire, or you keep changing jobs and that money's still yours. You just have to do something about it. It just doesn't automatically get from one to the other. So, but it's beneficial to the boss, to the business owner, or to the employer to offer these types of benefits to you, because they get a break from the IRS for doing so. Okay, so beyond offering you these plans, most of them also offer a match. So what is a match? When you sign these papers, if you took the time to read the fine print in there, you notice that there is sometimes an opportunity for you to go all the way up to your maximum investment on these types of retirements. So every year, the IRS allows you a max amount to put into these plans. And most of the time, your employer, your boss, the business owner will match a certain amount, a certain percentage. And so let's say that, so this year for 2022, the max in here, the max for this year for anybody that's younger than 6 years old is 22,000. Okay. So 20,500 actually. So the max that you can put into the plan is 20,500. They don't allow you to put any more than that. Let's say that you live with your parents and you don't have any bills and you want to put all of your salary there. You can't. There's a cap to how much you can put into these plans. And that's this year's 20,500. Now, next year is going to be 22,000. So every year it grows a little bit more. If you are of a certain age, if you're older than a specific age, then you can put in more. So because they allow you to catch up. Let's say that you have not worked, or let's say that you're just entering the work field and you have not contributed yet, or you contributed too little. You are able to contribute later in life. As you get older, they allow you to contribute more. But generally, every year goes a little bit higher. And so there's a percentage that your boss is allowed to contribute. There's a cap that they can be allowed to put in. Let's say that you choose to do everything. They're not going to match everything that you put in. They're only going to be allowed to contribute. Generally is 3% of what the max is. So if you contribute 100% for the year, they're only allowed to contribute 3% of that amount that you contributed. And that's your match. That's free money to you. So a match does not get taken away from your salary. It does not get taken from your bonuses. Does not get taken from any part of your income. So your income is flat with what they already signed the agreement with you, and then they put in more money. So that's an incentive. That's more that the business owner or your boss is giving to you. So it's an incentive for you to stay with them. Okay, so that's a match. It's free money to you, which is awesome. A lot of people take full advantage of that, and they will match what their employer is putting in there. So let's say you cannot afford to put your max in there, but you can afford 3% or 2% of your income to go towards these plans. So if your employer is going to put 3% and you put 3%, then you have 6% of your income, or 3% that you put in, and then three more that's free money that's going to go straight to your retirement, which is an awesome benefit. Okay, so the employer does that for you. You do that for yourself. When you do that for yourself, you are putting in every single year either the max or the amount that you can afford to put in there. And it's automatically put into this account. It's going to sit in there for you. Now, when are you able to use that? You're able to start using your 401k or what you have put in there after your retirement age. So, for this specific product, a 401k, it's 59 and a half years old. So, whether you choose to retire at that point or not, you can start withdrawing from this plan without any type of penalty at 59 and a half years old. So let's run through the scenario how that works. Okay, you're hired, you apply for a job, you're hired, and you go in there and you go for your onboarding, and you're filling out a paperwork, you're filling out, your address where you want your money to be deposited in, you're choosing your health benefits, all the other benefits that are attached to having a job at that place. And one of these papers is your retirement plan. Whatever they offer you is what they're going to show you that they have options for. Now, let me ask you this question. Did you remember filling out this paper? Do you remember signing this paper? Do you remember how much of the percentage that you're going to be having taken off your paycheck every single pay stub? Do you remember what they're going to do with this money? Do you remember the name of the company that or the investment company they're going to put the money into? And how do you access that plan? Do you know the name? Do you know the percentage of growth for yearly? Are they investing for you? Are they putting it over there in a savings for you to then make the choices to invest? Do you remember any of this during your onboarding? Do you recall any of that information? Because if you don't, this is the time for you to take a break from this video and look up the information from your HR department and go ask about these things, because you do have a retirement fund that you're very unaware of how the money is going, but it's your money. It's part of your salary that's going onto this thing that you don't know very much about. So let's get educated about that. So if you don't recall any of the details about your 401k, take a minute this week, go to see the HR department and see what they're doing with your money. And maybe you can educate yourself a little bit more about that. So most of these 401ks have two options. One is what we call a traditional plan, and the other one is called a Roth plan. And so what is the benefit about the traditional plan? So the traditional plan works like this. Let's say that you sign an agreement and you're going to work for a company and you're getting paid $100,000 this year, right? So yearly salary is $100,000. If you choose to invest on a 401k, 10%, so $10,000 out of your salary, then the HR, before they write your check every month, they're going to take an amount that's going to total $10,000 for the year. And that $10,000 is not going to show as income. So it's going to be pre-tax. So for you to understand what pre-tax means is in the process of where to figure out how much tax you're going to pay, where does the 401k lie? It's pre-tax or post-tax, after tax. So pre-tax means they're going to calculate how much they're going to remove from your taxable income before your tax bill is written or when you file for your taxes. So if you earn 100,000 this year, but you invested 10,000 on your 401k, then you're going to only have taxes paid on 90,000 income because it's pre-taxed. So you invest 10,000, so you already pay the taxes here, and now you're going to be doing the taxes on 90,000, not 100,000, right? So you pay your taxes on that, and that goes. Now our Roth is different. Our Roth is the opposite of that. You're going to pay your taxes on the 100,000, so it's after tax. So you're going to show on your IRS filing on your tax return that you earned 100,000. So you pay your taxes right now. But once you invest on that employer plan, now when you retire, you're going to be able to have that money grown tax free. So when you are choosing what type of retirement, if your employer has both options, the one that you pay taxes on right now, you're not going to pay taxes when you withdraw. But if you don't, if you withhold the taxes, so you get tax only later, when you withdraw later in retirement, then you have to pay taxes on that money. So let's say that you choose a traditional plan. A traditional plan, you don't pay taxes now. So 100,000 earnings, you're going to only tell the government that you only earn 90 because the 10,000 you put on your traditional IRA. That, and then you work. That money grows. At retirement, when you pull out that money to live your life at retirement, every time you pull out that money, you have to pay taxes on that withdrawal as if it is income, because you haven't paid taxes on that money yet. So you have to imagine what your life is going to be like at retirement, what your tax bracket is going to be at retirement. I'd say that right now you have live a modest life and your tax bracket is on the 15%. So you're only paying 15% on your taxes right now. But let's say that you become a millionaire at retirement and now you're on the 40% tax or 50% tax bracket. You'll be paying taxes on that money at retirement. Every time you take that money out of your retirement, at that point, you're going to be paying 50% on that tax, because on that money, because then you're going to be paying taxes. Now, if you do the opposite, if you choose a Roth product, you pay your taxes now when you're working and you're in your modest life and you're only at 15% tax bracket. Now you pay your taxes now. And once you put that money in there, it will grow tax free. And at your retirement, when you start taking that money out to live out your retirement, you don't have to show the government you're pulling out that money, because that is no longer taxable. You pay taxes now, which means you don't have to pay taxes later. Okay. A caveat to that. So, and I'm just gonna, if you want to send me any questions about that, I'd like to just point out that, let's say that you invest on a Roth product right now and you withdraw tax free later on. If you are also receiving Social Security benefits at your retirement and your Roth distributions are so large, you may impact your Social Security benefits. Just think about that for just a minute, okay? Because I want you to understand that these go hand in hand. Because these are protected plans, they have special protections from the IRS. They also want to make sure that you don't overdo it, because the government is always going to want your taxes. They always want to tax your money, right? So just dialing back a little bit and talking about the Roth product for a little bit. The Roth product is fairly new. It was introduced in 1997. So it's like what, 27, 28 years, 25, 20, whatever. 1997. William Roth, who was a senator from Delaware, very conservative Republican senator, wanted to offer tax cuts, and he wanted to introduce this type of legislation that would encourage entrepreneurship and business ownership. And so by offering a product where you pay taxes now, but then you remove that money from your investment tax free later, he wanted to give people an option to do so, where the larger part of your investment, you're encouraging business owners to grow and to develop larger businesses. And then later on in life, when you are wealthy, you don't have to pay the taxes. So that's what he wanted to do. He wanted for you to pay taxes now, but then later in life, you would not have to pay taxes. So that's why he introduced the Roth product. So the name of the product on the IRS code is named after Senator William Roth. And so you look him up later. So that's what he wanted. He wanted to give an opportunity for employees to invest their money tax free. So invest now, pay your taxes now, but then when you are older, you can withdraw that money tax free. So this is what happens when you are on onboarding and you work for somebody else. This video, we're not going to be talking about plans that are available for self-employed people and people that own their business. So we're talking about people that work for other people. Okay, so the 401k is a plan that your employer is going to provide you. So the business owner can deduct. So if you're the business owner, you're the boss, the benefit to you is because you're going to be able to deduct the cost of these products and the cost of the match as a cost of doing business, which means that's a tax benefit to you. So if you own a business and you offer an employer benefit like that, then you gain tax benefits. So that's why you want to do that as an employer. Now, some employers don't have a large, they don't have many employees, so they have to make sure that the whole system, the whole program that they're offering is viable and beneficial to the business for you to offer. And that's why I wanted to talk to you about a little bit of make the comparison to insurance. The pros of the 401k is the plan is an automatic thing. So a person that says, okay, I want to just do this, I don't want to think about it, I want somebody to do it for me. That's a good way to do it, because when you do your onboarding, you sign the paper, and then they're going to take that money out of your paycheck. You're not even going to see it, so you don't have to worry about spending it before they take it. You don't even see the money. It's automatically done for you by your employer. Of course, the other benefit is the match. So you have free money coming into you. If your employer maxes out that match, usually around 3%, they're going to give you that free money throughout the course of the year. The one caveat about the match is the vesting schedule. So you want to pay attention to that, because sometimes as you start working for somebody, you sign up for that and you understand that you're going to get the match. You sign up for the 401k, you understand that the employer is going to give you the match, but then you don't like the people, you don't like the work, and you get fired or you quit the job. You need to look at the fine print of when your match is vested. What does that mean? When is it going to solidify into your plan? Sometimes they say it's 12 months, sometimes it's 24 months, sometimes it's 5 years, sometimes it's 10 years. These employers use these types of programs to keep you there. Retention, it's a retention tool, which means they're going to put a minimum amount of time that you must work with them for that match to become real. So they're going to be putting that money aside for you. But if you leave work or if you're fired before that period where it's called vested, you have not really truly earned that amount. It's just there waiting for you to complete that period of time where you serve in that company. And if you're not vested, you do not get that money. That match that it was promised to you with the contract must go through the vesting period. If you go through the vesting period and you don't fulfill that time frame of service and you get out of that job, you do not earn that match. So you want to make sure that you understand what are the vesting schedule and all that you need to do in order for you to really fulfill that part of your deal for you to be able to gain that matching amount. And it's done for you at a later time. So let's say, okay, I am, my job as an employee, I want to come over here and I want to work for you and I want you to take care of that for me. So then if everywhere you go to work, you sign up to have a plan like this, when you retire, it's done for you. You don't have to think about it. You don't have to do anything. You retire and then you start collecting that paycheck from these plans that you signed up to do. So these are the benefits of a 401k. Now I want to touch base a little bit about the cons. What is this? Why is it that it would not be a good idea? The first one is a cap. So let's say again, like I said, if you're independently wealthy and the money that you're making, you'd like to put in as much as you can on this plan. There's a cap. So it comes to $20,000 that for the year, you can't put any more. So then you have to have another type of plan to invest more money for your retirement. Let's say that you started working late. Let's say that you have been a housewife for a long, long time and you have contributed nothing to your retirement. And now you're 45, you're 50 years old, and now you're going to enter into the workforce. And now you want to contribute as much as possible, but you cannot do anymore. So then beyond your 401k, you have to come up with another plan if you want to contribute more than $20,000 a year. Okay, so that's number one. There's a cap, there's a max that the government allows you to go into these programs. The number two is if you are working, let's say that you are in your 20s or your 30s, and now you have an emergency, you want to buy a house, you have a baby, you have a big move, and or you have a parent that passes away, and you need to use some of that money that you have contributed to these plans. Without a penalty, you cannot withdraw that money until you're 59 and a half, because these plans are for your retirement. So they don't want you easily touching that money. They want you to leave that money there so they can invest it and grow it for you. So then you do have retirement money. So then there's a penalty if you remove that money before 59 and a half years old. There are a few exceptions. COVID allowed for a few exceptions. There are other exceptions, disability. There's a bunch of there's a few important exceptions that you can look it up on the IRS code, that you can use your 401k money without paying the 10% penalty. But otherwise, if you take the money out before 59 and a half, you have to pay a 10% penalty plus the taxes if it's a traditional plan, which means it's 30%. So whatever you grew in there over these years, you're going to lose it. So you're better off not touching it. Although you may need the money, you're better off not touching it just because it's too expensive to move the money out. So that's the second con. First one is the cap. The second one is the fact that there's a date that you have to leave the money there. You can't be touching it. The third thing I think that is a con is it's not really clear. It's not really clear when you onboard into a job. Let me ask you this question. Do you remember if your HR is investing your 401k on small caps, mutual funds, bonds? Do you know where your money is invested right now? It's your money, remember. The 401k is your account. The employer is just managing that for you. But have you directed those types of investments? Are you a high risk investor? Are you a more conservative investor? Because if you did not tell them where to invest your money, they're doing it on your behalf without you knowing. So if you're not really clear where your money is going, again, this is a good time for you to have a conversation with your HR department to see where your money is, or ask them to see your investment portfolio to see where your 401k money is being invested and how is it performing. You want to know, because it's your investment, it's your retirement. The third thing is that with 401ks, you also have a required distribution at 73 years old. So let's say that you are independently wealthy, you retire at 62 or whatever, your Social Security is fully funded, you're receiving a good amount from Social Security, you have some money, you already paid for your house, you don't need to take out the money from the 401k at 59 and a half or whatever. Well, at 73, you must take it out. You don't have an option. You cannot just leave it there for future generations. You must take it out. It's called required minimum distributions, and they start at 73 years old. So these are the cons on my book, that this is not, it's flexible, but it's not, it's good for you because it's automatic, but it's not good because you really don't have a handle on anything that's going on there, except for the fact that they're taking money out of your bank account or your paycheck, they're putting it somewhere, and hopefully you'll have. The other thing that I want to talk to you about as a financial advisor is, if you are not sure of all these things that I've already asked you, and you are not sure exactly how much money you're going to have at 62, 67, 72, 75, exactly how much money you're going to have on these plans, then you also want to question that. Because with the Social Security Administration, that when you open your SSA.gov website and you log in and you see how many points you have accumulated, you know how much money you're going to have when you retire at 59, 62, 70, whatever. So it has there the scale of all the amounts that you're going to have when you retire. How about on your 401k? And I'm going to suggest that it's not going to be available to you because these products are investments. So they're not guaranteed. Every year, they're going to perform at a different level because they're index products. They are investment products. And so you really don't have an exact guaranteed picture of what that's going to look like when you want to retire or at the age that you project retiring. So let's say that you say, okay, at 70 years old, 60, 65, 62, 69, whatever it is, when you decide to retire, you want to know how much money you're going to have, right? You want to have that plan ahead of time. And most of these plans do not give you an exact guaranteed plan, an exact amount for you to count on, because again, they're investments. Okay, so to me, that's another con of these types of products. Another thing that I want to discuss with you when you are looking at 401ks, when you work for somebody and you have these monies that are available to you, sometimes you're not 59 and a half and something happens to you and you should designate a beneficiary to your 401k plan. Your 401k plan, if it's a traditional plan, will have taxes. So the person, your beneficiary, will have to pay taxes on that benefit if they receive it. Let's say that you're to pass away or you become incapacitated, and there's a beneficiary receiving that money. There are tax implications on that payment to your beneficiary. So you do want to remember that if you were not taxed right now, you will be taxed later when you collect that money from your 401k. Okay. So why is it that I brought up insurance on this information? So the 401k, I hope I kind of broke it down for you, kind of went through the details of it. If there's something that you had a question about when we were talking, please message me, put in the comments. I want to be able to answer because really did not cover everything. If you want to go to irs.gov, there's a lot that you can find out right there. It's really easy to read that website. It's not very difficult. Or you can just Google. There's a lot of videos out there that have comparisons of the pros and the cons of the 401k. There are other plans that are called a Roth. There's a 403b for federal employees and teachers. Instead of the 401k, it's called the 403b. It's the same, pretty not the same. There's a lot of similarities on those types of plans. It's a retirement fund, but it's for federal or state employees or teachers. Okay, so those are the types of things that employers will offer you for you to prepare for retirement. There are three pillars when I choose what to do with my money. So there's three questions that I ask, and I always ask these three questions before I make a decision regarding my money. The first question is this money that I'm going to do something with it, will it be whatever the plan is it guaranteed for me? What is the type of guarantee that I'm looking for? Will it be secure? Will I lose it if I put it in there? Would I gain? And if I gain, is the gain guaranteed for me? Let's say that you tell me that it is a mutual fund or it is invested on a bond. Is it a guarantee? And if it is guaranteed, is it guaranteed until I take it out? Is it guaranteed for a period of time? I want to know what guarantee am I getting when I put my money there? Because for me personally, if I'm going to lose it, I need to see what is my risk, and I want to be able to make that decision. So number one is whatever you're asking me or proposing to me that I put my money in there, is there a guarantee in that plan? Is there a guarantee in the percentage? Is there a guarantee in security on that? The number two pillar is liquidity. What does liquidity means? It means, am I able to use that money? If I put it in there and I let it grow and I believe in your guarantee, if I need it for an emergency, for an investment, for a big step in my life, can I take it out and use it? Here's an example of a non-liquid investment. Real estate is a non-liquid investment. So if I buy a house and I grow equity on that home, and now I bought the house for $100,000, and now the house is worth $400,000, I have $300,000 of gains. But I can't just go and withdraw the money there if I want to buy a car, or if I want to have a trip, or if I want to have a baby. I cannot take that money out of there unless I pull out a HELOC, which a lot of people do. But the liquidity of the investment, can I take the money out? Is my money growing in there and I cannot take it out? Then is it worth it for me? Is this the type of business or the investment or the whatever the product is, do I want to put my money there? Because if what if I need the money? Okay, so is it guaranteed? Is it liquid? And number three, will I have to pay taxes on the gains of that product or the service or the whatever investment? Will I have to pay taxes? Because there's a video of a young girl that has she's pretty young on the internet, and she's just figured out that money is double, triple, and quadruple taxed. So she says, are you trying to tell me that just because somebody earned the money, they already paid taxes on, they give it to me for a service that I provide them, I'm going to pay taxes on that money too? Same money, right? Somebody has $500 that they already paid taxes on because they earned it. Then they pay me for a service. Now I'm going to have to pay taxes on that $500. Then I'm going to go out and I'm going to spend that money and I'm going to give it to somebody else. That person's going to have to pay taxes on that. Yes, it is. So when we talk about investments, will I have to have that money be taxed again? I already paid taxes on that money. I either paid taxes because I earned it or because somebody already paid taxes on it and it's given to me, and now I have to figure out a way to not pay taxes on it. So number one, guarantee. Number two, liquidity. Number three, taxes. I want to be able to have that money be invested tax free. How am I going to make that happen? One of the reasons that I myself, Anna Farrell, did is I opened my own business. So because I am an entrepreneur, a business owner, I have more benefits in a tax code that allow me to deduct a lot of things from my earnings in order for me to lower my tax liability. And so when I invest my money, I also want to be very careful to invest in things that are going to be tax free. And so when we talk about these three items, these three pillars of money and how we best take care of our money, the only product that exists in the market that has those three packed is life insurance. Life insurance policy, not term life, not index policies, but whole life policies with cash value. And the reason why I say that is because when you have life insurance that is indexed, it is not guaranteed. When you have life insurance policy that is indexed universal life, that is not a guaranteed product. That is an index product that is invested, which means it cannot promise you those numbers at specific ages. Like I said to you, remember when I asked you, do you know how much money you're going to have at 52, at 60, at 70? You don't know that with an index product, but you will know that with a whole life policy because it's a contract for life. The second thing about a whole life is that it's liquid. Although you're putting in your premiums there, you're allowed when your agent designs that policy, they allow you an extra room in there. You decide how much money you're going to want to put in that policy extra yearly that you're allowed to put in there. And that's going to grow tax free for you. So there's a tax free part, but it's becoming liquid for you. So let's say that I want to flush my salary through that policy. So let's say that I earn $20,000 a month and I have a policy that I deposit $20,000 a month in premiums every month. But let's say that at the end of the year, my clients are really looking for my product and I have a boost in sales and I have another $50,000 in earnings just in the month of December. I need to have a policy that allows me to then put that money also into the policy beyond my premiums, and that money is going to grow tax-free as well alongside my regular premiums. But if I in January decide that I need to buy more things, I need to grow my business, I need to buy real estate, I need to invest in cars or marketing or whatever, I can go in there and take that money out and use that money. So it's liquid, guaranteed, because then I do have a contract with a company that tells me at year one, this is how much money you're going to have in your cash value and in death benefit. Year two, year three, year four. So if I want to project when I want to retire and I want to look at my Social Security, my other investments, and my cash value policy, I know exactly how much money I'm going to have every single year of my policy because it's a contract that is signed between me and the company that's going to produce those exact percentages every single year. Okay. And then the third thing is that it is tax free. Not only the money grows tax free and my retirement, I can withdraw that money and use that money for whatever I want, it is not counted as income. So for all of these products that we're talking about, the 401k, the Roth, the SEP, the IRA, all these products are considered income, right? So when I take the money out, I either take the money out tax free or I take the money out taxable, but it's considered income. It's going to weigh together with my Social Security benefits and it may impact my payment of Social Security. A life insurance policy is just a withdrawal from your regular savings account. It will never count as income, which means when you're using your cash value and you accumulate in there and you have 30, 40, 50, $100,000 in earnings on that cash value that you can withdraw at your leisure. You don't, if you want to tell the company to pay you a monthly deposit in your bank account, you can. If you want to leave it open for you to do that exchange, you put it in, you take it out, whatever you want to do, it will never count as income, which means it's not going to impact your Social Security benefits. So that's another great benefit of the insurance with cash value, because it will never touch your Social Security benefits that you have paid into. Your FICA uh, taxes have been paid all your working life, and now you want to take advantage of that. But if you have too much money at retirement, it may be impacted because you have too much money. So you don't want to lose out on that just because you have too much money, right? So, and then the last thing I want to touch on is the difference in between the 401k and the insurance is that because the insurance is an insurance, when you pass away, you have now made your family wealthy. You have a death benefit to be paid to your beneficiaries that is tax free. Because it's a life insurance policy, the payout of a death benefit is not taxable. It is not inheritance, so you don't have to pay inheritance money on that. You don't have to pay. It's tax free. And again, it's number one of my pillars is this product tax free. If you have a 401k that is a traditional plan and it's paid into as a beneficiary payout to your family, you have inheritance tax that must be paid. So that money must be taxable. Now, a life insurance policy payout is non-taxable. So your beneficiaries will receive that money tax-free. So that's why I wanted to compare the two, because when you look side by side and you look at what you want to do, why do people invest on a 401k? Why do people put their money for later on? Why do people allow part of your income to come out of your bank, your check, before it comes into your bank? Because you want to have money in the future, because you want to be able to one day stop working and have income. And when you start planning, when you start looking at how that is going to play out and how unsecure these programs or these plans that are employer offered, they're not secure, they're not guaranteed, they're not as liquid as you'd want them to be. They have caps, they have all of these little boundaries that might not be the very best thing that you want for yourself. When you compare them to the insurance, you'll notice how much better you can have your what you're looking for, which is liquidity, guarantee, and tax-free income. You can count on the insurance for that. If you don't know how a whole life insurance policy would work for you, I want to talk to you about it. If you want to have a side by side comparison, we have softwares that show you what a 401k would look like and a whole life insurance will look like at 50, at 55, at 60, at 65 for you. If you do not have the details of your 401k plan or your Roth plan and you are unsure where your money is, how much money you have right now, how soon can you access that money, how late do you have to wait before you have to access that money, this is the week that I would encourage you to go and talk to your HR department and check that out. If you are self-employed, I want you to look at me right now. If you're self-employed, this is the time for you to decide on getting a plan like that, not only for yourself and also for the other people that you employ in your business. If you are a one member LLC, we have to have a conversation, because that's not the most intelligent strategy for your taxes. If you're a one member LLC, you're not taking advantage of all your tax benefits. Let's talk. I want you to leave me a message. And thank you so much for watching. I know that this is going to be beneficial to a lot of people that you know. So please share that with your friends. And if you have any questions, I am always available. Go to my website, anaapparel.com, click on the calendar, and schedule a time for 1 hour free consultation. And I hope to answer as many questions as I possibly can for you. Thank you for watching. In the next 15 minutes, we're going to start this all over again in Portuguese. If you have friends that speak Portuguese, come on over and we'll do this all over again. Thank you.